So I'm very excited to have with us today Thomas Castelli. Tom is with the Real Estate CPA. Brandon Hall and Thomas both, they help real estate investors and a lot of physicians reduce their taxes, streamline accounting, make better financial decisions to grow their real estate portfolios. I was actually in the first cohort of Brandon's tax strategy foundation course, and a lot of what I teach within the Creating Generational Freedom program and what I talk about, a lot of that is from that course. Brandon and Tom are both very conservative in this. They're very creative in their tax strategies, but also very conservative, just making sure you're always audit proofing yourself, very detail oriented. I've loved working with them, and I'm really excited to have you with us here, Tom.
Thanks for having me. It's an honor to be here tonight or this evening.
Yes. And for those of you who are celebrating Diwali, I'm so sorry. I completely forgot when we scheduled this, but we're going to make the best use of this time, and you're going to learn a lot of amazing strategies, hopefully get to a lot of the questions that you have. I've been tapping into a lot of these strategies for the last 3 years. And, as we're investing in apartment complexes, a lot of our members, investors, those of you who have invested with us, there's a lot of tax strategy that goes along with that, where you can really maximize your returns. And so I'm excited to dive into all of this today. You guys know I always talk about how with real estate, your returns are multifold, right? We talk about cash flow, market appreciation, forced appreciation, debt pay down, really using leverage to amplify your returns. How real estate is one of your best hedges against inflation. Today, we're going to deep dive into the tax savings part of it. I'm so excited to have you here, Tom. There are the real estate, the tax benefits of investing in real estate that have always been there, but there are these advanced strategies that a lot of real estate investors have been tapping into since 2017 that has allowed a lot of high income earners, including physicians, to drastically reduce our taxable income in certain circumstances. So very excited to dive into all of that. Tom, maybe you want to go ahead and just start about the benefits, the overall, the things that we've always had and how things have shifted since 2017.
Yeah, absolutely. So, I think it probably just to kind of give a quick overview and everything we're talking about today. So this kind of all stems from the Tax Reform Act of 1986, right? So before 1986, you were able to buy a rental property, whether it be long-term or short-term, simply place in service, rent it out to a tenant, and then you're able to use the non-cash expense called depreciation to generate losses that can offset your active income. So say a job or an active business or pretty much any type of income, no questions asked. And what ended up happening was around that time, it became really controversial. So Congress ended up implementing the Tax Reform Act of 1986, and that did a few things. It introduced Section 469 to the tax code, which made all rental activities passive by default. And what that meant is that you can only use the losses from these passive activities against other sources of passive income, whether it be another rental activity or perhaps a passive business. And so it's the second thing it did is it made all businesses subject to a test called material participation. And if you met one of the material participation tests, then that business was active. If you did not meet one of those tests, then it was passive. And that's kind of where the short-term rental strategy comes into play. But that's pretty much what it did. So what all investors can do, what all real estate investors can do is use the losses from their rental activities to offset passive income from other rentals. So in other words, this allows you to not pay tax on your cash flow. So you can you can basically put money into your pocket, but show a loss for tax purposes. And that is something that almost any real estate investor can take advantage of, which is fantastic. There's also strategies that allow you to use those losses to offset the gain on sale of rental property, whether it be a syndicate or whether it be a property you own directly. And the good news is that's available to just about anybody. So it's very interesting that, to kind of put a little bow on what everybody can do is it effectively allows you to increase your income without increasing your taxes, which means you can have a lower effective tax rate. Kind of give a quick example of maybe what that means is, let's just say, just for easy math, just say you made $100,000, right? And let's just say you paid $30,000 on that $100,000. Well, your effective tax rate would be 30%. That's what it would be. But now let's say that you were able to earn, I don't know, let's call it $20,000 from rental properties, and you paid no taxes on that rental income. Well, now you have $120,000 of income and you have $30,000 of tax. So again, example before you had 30,000, you had a 30% effective tax rate. Now you would have, I'm just going to do the math on it real quick. You would have now a 25% effective tax rate. And that's because you've increased your income without increasing your taxes. And that in a nutshell is one of the biggest benefits of investing in real estate is the ability to generate tax-free income. Sorry, you're muted, Param.
Thank you. What Tom is talking about here, the example he just gave is for anyone who's not tapping into those advanced tax strategies, real estate professional or short-term rental. If you're just investing in real estate and you're producing positive cash flow just because of depreciation, which is a paper loss that he was talking about, you're able to reduce your effective tax rate, even if you aren't tapping into those advanced strategies, right? So Tom, can we deep dive into what the passive activity loss limitations is, what the cutoffs are and how people are offsetting it at this point?
Right. So there's something called the special loss allowance underneath the tax code that says that if you're actively involved, and actively involved simply means you're making management decisions. So if you own a rental property, you have a property manager on it. If you're giving the property manager the thumbs up to make a renovation or a threshold that they should be, checking with you before they make a repair request or something along those lines, that's active participation. And if your income is your modified adjusted gross income, also known as MAGI, for the sake of this conversation, you could just consider your AGI. It's more or less the same. And if that's below $100,000, well, you could take up to $25,000 of these passive losses from your rental properties against your active or non-passive income. If your income is between 100 and 150, well, now that deduction phases out $1 for every $2 of income you have above that $100,000 threshold.
Yeah.
So, for example, if you were to make, just say, $125,000 of income, well, now your deduction is limited to $12,500 or $12,500. You don't get the full $25,000. Once you hit to 150 or above, that deduction is phased out completely, and you don't get to deduct anything. And for a lot of high income earners, that's a problem because you can't take the loss against your rental activities. So that's kind of the limits right there.
Yeah.
Now, there are ways around those limits. There's a handful of ways. The first way is the real estate professional status. And the real estate professional status was put into place around, I believe 1994. So from 1986 to 1994, if you didn't use a special loss allowance, there was no way for anybody to take losses from their rental activities against their active income. And just basically, long story short, a lot of lobbying in Congress, the real estate industry eventually got the real estate professional status into the tax code. What the real estate professional status allows you to do is to take losses from your rental activities against your active or active W-2 or business income. And now to qualify as a real estate professional, what you need to do is you need to spend more than 750 hours in a real property trader business and more than 50% of your total working time. And that's the one that trips a lot of people up and stops them, prevents them from being able to use the strategies, because it's hard to work a full-time job or run a full-time business and still work more than 50% of your time in a real property trader business, unless of course your business is a real property trader business. So that's how you qualify. Now, there's 11 real property trader businesses out there. I'm not going to go through all of them, but basically fix and flipping, wholesaling, maybe you're a real estate agent or broker, you're construction, you develop properties, or you're in rental activities, maybe you're a property manager. Those are all real property.
General contractors, Tom, do they fall into that category?
General contractors generally fall under the construction bracket. So, they would be considered in a real property trader business. So yeah, those are the real property traders businesses that can help you get to the 750 hours. But there's also another step. You also must be able to prove that you materially participated in your rental activity. So for example, say that I was a real estate agent and that was my full-time job. I'm easily going to hit the 750. But let's just say I have a handful of rental properties and I never do anything with them. I have a property manager. They do all the work. Unfortunately, I'll qualify as a real estate professional, but I won't be able to take the losses against my rental activity, use the losses from my rental activities against my active income. So in order to do that, I would need to meet one of 7 tests on my rental activities. And We're not going to go through all 7. There's really only 3 that really are matter to most investors, and that's you spend more than 500 hours on your rental activities, or you do substantially everything yourself, which pretty much just means you're a one-person show. You do just about everything, and maybe you have a handyman come and fix something, or someone help you out once or twice throughout the year, but you're a one-person band. And then the third one is you spend more than 100 hours on the activity, and no one other individual spends more time than you. So that means that you could have more people help you out as long as you're spending more than 100 hours and no one's spending more time than you. Now, if you're going for this status, the real estate professional status, and your only activity, your only real property trader business is your rental properties, and if you make that 750 hours and more than half your total working time, you're going to already have met that 500-hour test on your way there. So you're fine. You check the box. But again, if you're a real estate agent, you're in construction, you're in another real property trader business that's not a rental business, you still need to make sure you're meeting one of those 3 tests I just mentioned on your rental activities yourself. One more thing I want to throw in there, actually two or three more things, the real estate professional status I think is important to note. The first thing is that your spouse can qualify as a real estate professional. So maybe you work full time and your spouse works part time or doesn't work at all, and they want to get involved in the real estate business. Well, if they can meet that 750 hour and more than half their total working time requirement, then you both get the benefits if you're married filing jointly of the real estate professional status. And we see that a lot. It's quite common that people do that. So it's just something to keep in mind there. Also, in order for your hours to count towards the 750, you must own at least 5%, have a 5% ownership interest in whatever business that you're looking to qualify for. So if you are, if you work for a property management firm, for example, and you're an employee there, you have W-2 income, for example, and you don't own 5% of the company or more, then your hours will not count towards that 750, despite the fact that it is a real property trader business. So you have to have an ownership interest of at least 5%. Something just to note in there. And then those are pretty much the biggest. Okay, then the last thing I wanted to say that is that if you have multiple rental properties, you would have to meet one of those 3 material participation tests on each one of those properties, unless you make a grouping election that's found under section 469-9G, which is become known as the -9 grouping election. And what that does is allows you to treat all your rental properties as one activity, so that you only have to meet one of those 3 material participation tests on one of your rental properties. Across all of them and not across each one of them individually. So,
and if you have passive losses from syndications, you could group that into it also.
Right. So you can group them together using that -9 election. However, if you're going to take the losses from the syndications against your active income, there's the test you're going to have to meet is that 500-hour test on your own portfolio that you own. And the reason for that is that you're not going to be able to use the substantially all test, because the syndicators, the sponsors, they're doing a lot of work. Yeah. And that means that you're not doing substantially everything anymore. And B, you're in most cases, the 100 hours and no one else spends more time than you is not going to work for 2 reasons. The first reason is you're probably not going to be able to accurately track their time. So practically speaking, it's probably not going to work. And B, they're probably spending more time than you anyway. So if you're going to be using that test, you're going to have to use the 500-hour test, meaning you have to spend more than 500 hours managing your own rental portfolio in order to have those losses from those syndicates.
Yeah. Beautiful. Thank you, Tom. That was like so elaborate, and there's so much to unpack over there. So I'm going to go step by step. So for those of you you're here with us, 750 hours roughly translates to around 15 hours a week or more for you to be able in real estate, for you to be able to qualify as a real estate professional. So a few questions that I keep getting here often along those lines, Tom, are what if I work 0.8 FT? So what if I work 4 days a week in medicine and I still legitimately spend more time in real estate? How does that work? And what is my audit risk? So how many properties do I need to have if I'm working, say, 3 days for me to qualify? Or questions we get all the time. Do you want to take that?
Yeah. So it comes down to hours, right? So if you're able to substantiate, usually we recommend using a time log. So if you're able to substantiate that you spent more than 750 and more than half your total working time in real estate, and you had another job or you operate another business, that's fine. You're just going to need to be able to substantiate that. So that means you probably need to track the time you're spending in the other business or in the other job, because the IRS is going to automatically assume if you have, especially if you have a high paying job, that you're spending more than half your total working time in that job. And what that means is, or that business, and that becomes you have to overcome that presumption. So the onus is on you to do that. So you need to make sure that you have the time log for your real estate activities, and you also have some reasonable way to ascertain the time you're spending in your other business, so that if you are ever audited, you can clearly say, hey, look, here's my time log, here's my supporting evidence for the real estate professional status to show that I met those requirements. And also, here's the time I spent in my job or my other business to show that it was more time in real estate than in this other activities. And I'd go as far as even to say that you're going to want to have the time log is definitely one thing, but you may also want to have in your back pocket someone you could bring in if you are ever audited, like for testimony. Like, okay, here's my partner in my business, or here's my supervisor or my one of my colleagues in my business who could attest to the time that I'm spending in that other activity. So you could make your case stronger, because again, the IRS will assume that you didn't do it, and you have to overcome that burden.
Yeah, love that. Now, so many of you are listening to this and thinking, I don't really want to cut back in medicine. Maybe I cannot at this point. My spouse cannot. We're working full time. And I don't think we're ever going to be able to, we don't want to spend more than 15 hours a week in real estate throughout the entire year. Can we talk, Tom, about the short-term rental tax strategy that a lot of high-income people have been tapping into when they find themselves in the position where, at least for the foreseeable future, they don't see themselves going part-time or being able to meet real estate professional. So what's the other thing that a lot of high-income earners have been using?
Yeah, absolutely. So kind of just tying it back to what I mentioned before, all rental activities are passive underneath Section 469. However, there's exceptions to that definition of rental activities. And one of the exceptions, or two of the exceptions that are most common we see in the short-term rental space, are going to be uh, the average stay of the average customer use of the property is 7 days or less. So this just typically means that when you add up all of the stays you had throughout the year and you divide them by the total amount of days that people stayed, it was less than 7. You meet that, it's not a rental activity underneath tax code. It becomes a business activity, a regular business activity. And I'll get into that more in a second. The second exception that's relevant to most people in the short-term rental space is going to be the average stay is 30 days or less, and substantial services are provided to the guests while they're there. Substantial services are things that you normally find in a hotel: daily cleaning while they're there, daily breakfast, vouchers, to like ride vouchers or vouchers to local communities, guided tours, um, pretty much concierge services. Anything that you would really find in a hotel, that's usually going to be considered substantial services. And if you meet that criteria, it's also not going to be considered a rental activity. And again, it makes it a regular business activity. And that means that you do not have to qualify as a real estate professional to turn the loss as non-passive. So you bypass that 750-hour and more than half your total work time requirement, and you go directly to the material participation tests. Same 3 tests I mentioned before are going to be relevant here. You spend more than 500 hours on the activity, or you spend you do substantially everything yourself, or you spend more than 100 hours and no one else spends more time than you. And in the short-term rental space, that 100-hour test and more than anybody else, that is probably the most common test. And the reason for that is the 500-hour test. If you have one or even maybe 2 short-term rentals, it's going to be very challenging to meet that 500 hours. At least in my experience working with clients, that's what we found. The substantially all, you could certainly qualify doing that if you're ready to do everything, which typically means the property is located close by to you and you're ready to get your hands, dirty and clean in between stays and all of that stuff. We usually don't see people wanting to do that. So what we do, so that 100-hour test ends up making the most sense, because you could still spend more than 100 hours and you can come clean the properties in between the stays, in between guests. You could have a handyman come and do some work on it. And this works particularly well if you're doing this from afar, because these days with technology, you could still spend 100 hours dealing with tenants, coordinating with your cleaners, with your repair people, all that good stuff, and still meet this 100-hour test.
Yeah, that's just, guys, just to put that into perspective, I want to show you how impactful that can be. We have some of our members within Creating Generational Freedom this year getting up to 500,000 in losses that they can use to shelter their clinical income, just from 2 short-term rentals that they are materially participating in. And it's the end of the year. We have the fall cohort of Creating Generational Freedom. Greater than 75% of our members are trying to lock in a short-term rental before the end of the year. You see this all the time. Tom, you guys have a short-term rental tax course also, which I'm sure a lot of people are really interested in it towards the end of the year, because it's so much easier to hit that 100-hour material participation test and really make sure you're spending more time than anybody else around close to the end of the year. Can we talk a little bit about bonus depreciation and the numbers, how this actually works for like a property, so that people can understand, how much of an impact it can have?
Yeah. So, what really made this stuff really powerful over the last 5 years or so has been bonus depreciation. And bonus depreciation, what that allows you to do, it allows you to complete. So when you buy a rental property, let's just say it's a short-term rental, for example. Short-term rentals are typically depreciated over 39 years. So what that means is you buy the property, you're going to have to break out land. Land is never depreciated. And for the sake of this example, I'm just going to assume that land is 20%. Land value is typically going to be derived using the property tax card or independent third-party appraisal. But again, 20% for the sake of this example. And let's say you bought a $500,000 property. I'll keep that in the middle of the road there. That means $400,000 of it is going to be depreciable, because again, 20% goes to the land. That's $100,000. That's not depreciated. Now you use $400,000. Well, if you didn't use bonus depreciation, you typically get a depreciation expense of around $10,000, give or take, per year over 39 years. And just to clarify on depreciation, it's non-cash. So what that means is that on your profit and loss statement, you're going to have your income. Let's just say you had $10,000 of rental income, for example. Now let's just say you had $6,000 of hard expenses. And these are expenses like utilities, maintenance, repairs, maybe accounting and legal fees. Maybe you pay commissions to a leasing agent, whatever the case is, all these fees. And that would leave you with about $4,000 of cash flow. And in most other businesses, you're going to pay taxes on that $4,000. Now we're going to enter this depreciation expense, which is non-cash. And let's just say you have $5,000 just for this illustration here. Well, that's going to leave you with a loss of around $1,000, which means that you didn't pay tax on your rental income. Yay, that's what we are talking about before. With that's available to everybody in the tax code. Yeah. But now the question is, well, what happens to this $1,000 loss? Well, if you're going to be using the short-term rental loophole or reps, this loss will be non-passive and can offset your active income. But $1,000 loss isn't that great, right? So how do you really increase this loss? Well, that's where bonus depreciation comes in. And bonus depreciation allows you to depreciate assets with a class life of 20 years or less. And usually you'll be able to break apart your 39-year property or your 27.5-year property in the case of like long-term residential by doing a cost segregation study. Long story short, engineer comes to your property and they break down the components. They give you a survey. They give you a report saying your property breaks down to 39 years. Here's the portion that's 39. Here's the portion that's 5, 7, and 15 years. And you can bonus depreciate that 5, 7, and 15-year property. Now, the question always becomes, well, how much can I expect? How much can I expect to fall in that 5, 7, 15-year bucket? So this is going to be a range. This range is based off of just the experience we've seen over the last 5 years working with several cost segregation companies. Usually it's somewhere between 20 to 30%. And usually kind of somewhere in the middle of the realm, around 25% is usually what we see. So again, taking it back to our example, we have that $400,000 property. We're going to take 25%. And that's going to be $100,000. So $100,000 is going to be reallocated to this 5, 7, and 15-year property, which is going to be eligible for bonus depreciation. And this year in 2022, it is 100% bonus depreciation. So you're going to receive a depreciation expense of $100,000. So let's just take it back to the example before. You had $10,000 of rental income, and this is possible to happen. And then you have all your expenses, and you have this big, massive $100,000 depreciation expense. Well, that's going to put you at a loss. And let's just say, for the sake of this example, put you at $105,000 loss because you have some other expenses in there. Well, now this $105,000 can offset your income, and this is really where stuff gets powerful. Yeah. So let's just say you were making $200,000. Well, now all of a sudden you're only going to pay tax on, what's that? $95,000. So that can cut it down a lot. Now let's just say you're at the 37% tax bracket, to give it a number. And that's usually when you're making, if you're married, a little over 550 or so. I forgot the exact number, but
Yeah,
around that.
I think it's shifting for 2023 also, right? The numbers are going up.
Yeah, inflation, they're pushing those numbers up. We just got the report in recently. So if you're in the 37% tax bracket, that $105,000 is going to be worth, at the federal tax bracket, it's going to be worth $38,850 in tax savings. I mean, that's substantial, right? It's almost 40 grand. That can go towards a down payment in a house. It can be used to buy a new vehicle, or almost a new vehicle in some cases. So it's a lot of money, and it's really powerful.
Yeah. And, a lot of our members like using the 10% down home loan product, like the second home loan product. And so essentially whatever their down payment on the property is very close to, or sometimes, it's similar to what they're pulling out in terms of post-tax dollars saved, which is where it's almost like you get infinite returns and you're recycling your money and using the same pot of money over and over again to keep scaling. Tom, we talked about this a little bit earlier. We talked about material participation. And so there are lots of questions about what qualifies for material participation, especially for short-term rentals, right? Because a lot of people are trying to lock it in within the next month. The biggest question is about acquisition hours, right? Not investor hours where you're researching the market, but where you've actually picked a property, you put an offer in, you're talking to your lender, you're getting all the paperwork done, trying to form an LLC. Does all of that qualify for material participation hours for a short-term rental?
Right. So that's a good question. So it's a bit ambiguous. There's no clear, bright line test under the tax code that kind of defines that. But based on our experience reviewing tax court cases and everything we've done, we look at it as, once the property is under contract, and if, assuming you're going to be self-managing it, the time you spend, getting it under acquisition and walking the property, inspecting it, dealing with the lenders, doing all the due diligence you need to do to buy the property, that will count as material participation. So that assumes, though, you're self-managing. If you're not self-managing, that will likely be categorized as investor level hours by the IRS. So you have to be self-managing to make those hours really count, make the best use of those hours.
And then what about when you have cleaners and you have a cleaning crew? Now, do your 100 hours and more than anyone else, does that have to be, is it compared to every individual in that team? And this is true for a general contractor who brings his crew in versus for the entire team versus every individual in that team. How do you compare those hours?
So it's per individual. So we did a lot of research on this to confirm that is indeed per individual, not per company. So that means if you hired a cleaning crew and they had 3 cleaners, and cleaner A spent 25 hours and cleaner B spent 54 hours, well, then each one of those is weighed against your 100 hours. It's not aggregated, so it's not added together. So you can theoretically cycle out cleaners and make sure they're all below those thresholds, and you'll be in good shape.
That's awesome, because especially for those who are doing rehabs or who have cleaning crews come in, it's really good to know that especially if they're really close in terms of the hours that they're calculating. Perfect. In terms of losses, Tom, a lot of our members do this. They acquire, and I think some of them on this call also are in a similar situation. They're acquiring multiple short-term rentals that are luxury short-term rentals. So can we talk about, is there like a point at which you're capped in terms of how much you can take in terms of losses, after which it starts getting carried forward?
Yeah, that's a great question. So there's something called the excess business loss limitation. So what the excess business loss limitations do is they limit the amount of losses you can take against non-business income. So in other words, like W-2 or income from a job or anything that's not business income. So I believe that's around $524,000 in 2022. So as if you're married, and it's about half that if you're single. So basically, if you were to buy many luxury short-term rentals, let's just say you had a $700,000 loss, which honestly is not too out of the realm of possibility. Well, you would only be able to take 524,000, give or take, this year in 2022. The rest of it would be carried forward into the next year as a net operating loss. And once a net operating loss, it can offset your income the following year up to 80% of your net income. So that's the limit in any given year. For your current year losses is going to be that $524,000 number that's indexed for inflation. And then the excess amount just gets carried forward to the following year.
And so even if you haven't materially participated in that short-term rental in the following year, because it's carried as a net operating loss, those are like
Right.
active losses that are different from passive losses, and they will shelter your clinical income.
Right, because it was generated. So net operating losses are losses from an active trader business, whereas passive losses from non-passive. So because it was generated as a non-passive loss in the year that the loss is generated, it's the NOL is going to be non-passive moving forward.
Awesome. Yeah, that's just amazing. And that's true for even the passive losses we've been talking about before. And in those situations where you have rentals where you may be generating paper losses from your rental that that are in excess of your cash flow, they will still get carried forward into future years. You never lose it. So you always serve by maximizing, just making sure you're recording and logging everything and taking all the losses you can. Tom, just a little bit of a diversion, but in terms of passive losses that you accrue over time because you've owned real estate, right? And because of depreciation, when can we talk about the scenarios when those losses are actually released and they become active? I think we talked about a couple of them before.
Yeah. So there's a handful of ways that losses become non-passive. And I'm just gonna real estate professional status, short-term rentals, we just went through those. The special loss allowance is the other one. Now, what happens to these losses once they're suspended? They will be unlocked, quote unquote, when you have net positive rental income, for example. So if you have rental income or income from other passive activities, like maybe a passive business that you might have an interest in, those losses will offset that income, so that they can be used in future years to make sure that you continually don't pay taxes on that passive income. They will also be unlocked when you sell an activity. So when you sell a property, those losses that are associated with that property will be unlocked and will offset the capital gain from that activity first, including depreciation recapture. And then it'll offset any other passive income you may have for the year. If you have any, if you don't have any, great. If there's anything remaining after that, well, then it will offset your non-passive income. However, I will state this, that in my experience over the last 5 or 6 years doing this, we've seen a tremendous run up in the market. And most of the time, the clients that we've been working with haven't had any excess losses after that. So meaning what happens is they sell the property, they have a very large capital gain in many cases, and those losses get unlocked, offset the capital gain, and there's just not enough losses left over to offset their non-passive income. So while it does kind of work that way, that's theoretically how it works. In practice, at least in the market we've seen over the last 10 years or so, you don't actually see people taking those losses against their non-passive income in many cases.
Yeah. And and it just goes to highlight the fact that because all these losses are carried forward, you really want to optimize your accounting, make sure you tap into all the benefits that are afforded to you. Just because in the end, when you're minimizing your capital gains, you're overall increasing the ROI for yourself. So it's always good to work with a real estate savvy CPA. I've seen some of our members come in where they haven't been taking depreciation or they haven't been carrying forward losses, and the IRS, it's mandatory for you to take depreciation, so they're going to factor all of that in. You're going to have a recapture, and so ideally you want to be working with someone who knows what they're doing, because a lot of errors can happen along the way. So going back to short-term rentals, Tom, another question we get is, so suppose someone runs a property as a short-term rental this year, what happens if the following year they want to convert it? A lot of times they want to convert it to a midterm rental. There's also the possibility they want to convert it to a long-term rental, and that's their exit strategy. How does that work if they've taken bonus depreciation in year one?
Yeah. So I'll give you the theory, and then I'll give you a kind of the practical answer. Okay. So theoretically, you can. So the way short-term rental work, it's an annual test, meaning the 7 days or less. That's measured on an annual basis. Whether or not you materially participated is measured on an annual basis. So if you were to have a short-term rental in 2022, for example, you were to materially participate. Now the following year, it happens to have an average stay of 8 days, and you're not providing substantial services. Well, then it's going to be a rental activity by the definition of the tax code, and it would be passive unless you're a real estate professional. Same goes if you were to you turn to a primary residence the following year. It would be your primary residence. You don't recapture any of the depreciations you took in 2022 in that first year just because it becomes a long-term rental or because it becomes, say, a primary residence, for example. So you would only have to recapture that depreciation when you ultimately sell the property. So that's usually not an issue, and that's kind of the by the book rules, right? Now, the IRS the reason why section 469 was put into place way back in the 80s was to prevent people from taking losses from their rental activities who were not, that was the reason why I put in place. And the IRS knows that people take advantage of these. So what they do is they try to look for ways and holes in your story and other areas of the tax code they might be able to use to break your story, if you will, if you were under audit. And the way they might do that is a handful of ways. Like, for example, say you were to rent out a property towards the end of the year, we're going to recommend that you have as many stays of 7 days or less, or as many guests stay at the property, and you're under that 7-day threshold, as possible, to really substantiate your position and make it a legitimate business activity, and not just something to use this just to use the tax benefits. Because under the tax code, there's a section where the IRS says, basically, if you're doing this stuff just to get around the passive activity losses, they can disallow it. So you want to avoid painting that picture. So you want to have as many stays throughout the year as possible. And then ideally, if you're not using it through the majority of the year, and you're just placing your property in the service towards the end of the year, you're most likely going to want to rent it out as a short-term rental for some period of time the following year, to again to paint that picture. Because the biggest concern is that, sure, theoretically on paper, those are the rules, but the IRS could come in and kind of botch your situation. But to answer your question from before, if you were to do that, you would not be recapturing any of that depreciation. You still capture the benefits in the first year.
Does it place them at an increased risk for audit, so if they were to do what you're suggesting is that they run it as a short-term rental for as long as they can, even into the following year, before they make that transition into midterm or long-term.
Exactly.
Perfect.
Because it just runs the risk that under audit, the IRS could find some kind of hole in your story to disallow it. And the more it appears that you're running a short-term rental business and it's not just for the tax benefits, the stronger your position is and the less risk that your position is going to carry.
Makes sense. So I'm going to get into some of the questions I pulled from our members before, Tom, so this may not have as much flow, but a lot of people are acquiring short-term rentals. And if they're already furnished, or if they intend to do rehabs on those properties before placing them in service, is there a way that they can optimize, their tax savings by, timing the rehab in terms of de minimis safe harbor, being the ability to use that if they place it in service first and then do the rehab later? How does furniture work when it's already a furnished, short-term rental? Can they expense those things out?
All right. So furniture. So if you buy a property that's a short-term rental already, or built to be a short-term rental, or was previously a short-term rental, and it comes with all the furniture, well, furniture is 5-year property. So that would be broken out in a cost segregation study and eligible for bonus depreciation. Now, if you're going to actually furnish the property yourself, anything you do before the property is placed in the service, which is typically going to be the date that it's available for rent, so it's ready to go, someone could come rent it out today and live in it, cool. And it's listed for rent, so that's the place and service date. Anything you do before that date is going to be capitalized to the property, and so that would mean that if you were to buy property today and furnish it today, you go to IKEA, buy all the furniture, all that good stuff, that's going to be capitalized, and it's going to become 5-year property that could be depreciated. Okay, albeit bonus depreciated, so that's good news. But it's going to be capitalized and depreciated nonetheless. Now, let's say that you bought the property, you got it rent ready, and you listed it for rent, and then you bought the furniture. Well, now that because the property is already placed in the service, you can start using something that's called the de minimis safe harbor, which you mentioned, and that means that basically expenses with an invoice line item of $2,500 or less can be expensed immediately that year. That means it doesn't have to be capitalized, doesn't have to be depreciated, which is more optimal because you get to avoid depreciation recapture, and you don't have to worry about longer time horizons maybe on the property. But so let's just say the furniture. Let's say you bought a couch for, I don't know, let's call it $2,400, just for sake of example. That's below $2,500. So you'd be able to expense that couch immediately this year, not have to depreciate it. And it's just an expense. And that, again, an expense is better than having to capitalize depreciate it, because you get to avoid depreciation recapture later on down the line.
Awesome. And that's good to know. I mean, at least from a planning point of view for people. Tom, let's talk about bonus depreciation for a business vehicle if you purchase
Right.
it in 2022, because a lot of people end of the year, they're trying to get something. So how does it work? What is the criteria that needs to be met for them to be able to, purchase it for their business, use it, and bonus depreciate it 100%?
Okay. So there's a few requirements. So the first thing is the vehicle must be used more than 50% for business. And that's going to open it. That's going to allow you to start using stuff like bonus depreciation. That's the first requirement. Secondly, the vehicle has to have a gross vehicle weight rating of 6,000 pounds or more. That's typically heavy. It's typically full-size SUVs and pickup trucks, things of that nature. So once you do that,
Minivans included.
Certain minivans for sure can be included in that. So okay, so where I was going. Okay, so basically you do those things and you're able to bonus depreciate the business usage. Now there's a special strategy around year end that people like to use, and that is they will buy the vehicle maybe November or December of the year and use it exclusively for business, meaning they don't drive it personally at all. And I think I might be lagging it here for a second. So I'm just turn off my video just for 1 second to get through this, and then I'll get back on it. So okay, so they buy towards the end of the year. They use it exclusively for business purposes. Now they say get 100% business usage. So now the vehicle's used 100% for business, and now they can use 100% bonus depreciation to depreciate those. So long story short, that's how it works. Again, just to recap, you're using the vehicle more than 50% for business. Ideally, you're purchasing it towards year end and using it exclusively for business. And then you're using 100% bonus depreciation on it as long as it has as long as it has the gross vehicle weight rating of 6,000 pounds or more. Those are the requirements.
Awesome. Now, Tom, does it need to be in the business name or can it be in your personal name, and can it be financed?
Yes, that's a good question. So we almost always suggest it being on your personal name, and that's just because it's a lot easier to do that. As a lot less regulations around that. And it's just better because if it's in your business name and you use it personally, you could cause some tax issues if you do that. So we generally recommend avoiding doing that. As for it being financed, yes, as long as you're buying the vehicle and you're taking ownership of it and not leasing it, doesn't matter whether you buy it all cash or you buy it with a loan, you could still use that depreciation.
So if it's financed, you still get 100% bonus depreciation in the year that it's placed in service.
Right. So yeah. Sorry, go ahead.
Sorry. Go ahead, Tom.
I was gonna say, just for example, if you bought like a $4,500 Ford F-150, and use it exclusively for business, you're able to deduct that entire $45,000.
Yeah, perfect. That's for everyone who's been asking me about purchasing a bit. So a business vehicle, meaning if it's specific to that, so it doesn't even have to be under the business name. You can purchase it in your personal name and take the losses under the business if that's what it's categorized to.
Well, yeah. So basically, long story short, on your tax return, it's going to be associated with that business activity, and that's pretty much how that it'll just be deducted against that business's income.
Awesome, Tom. Yeah, like so much good stuff here. I'm going to go over some of the questions that we're getting in the chat because there are loads of questions. We'll try to get through as much as we can. Okay, so is it true that purchasing a short-term rental with 10% down means that we would need to self-manage and cannot use a property management company? Are there ways around this? I'm wondering if this question is more pertaining to lending and mortgage, and what the lender would require. I don't know if you want to take that question, Tom.
Yeah. So when it comes to taxes and lending, it's kind of separated. The IRS doesn't really care, or the tax authorities really don't care what the bank classifies the loan as long as you use the proceeds towards the purchase of a rental property, the interest will be tax deductible and you're generally going to be all set. However you purchase it through the bank, the IRS more or less just they don't really care about that.
Awesome. So this is a question we get a lot of times, and honestly, a lot of CPAs who aren't really working with real estate investors a lot also get this mixed up. So the question is, do you need to have a real estate license to qualify as a real estate professional for the real estate professional status, Tom?
No. So you do not need to be a licensed real estate agent to qualify as a real estate professional. That's you don't need to do that.
Okay,
Which is fine.
perfect. Yes. And it's like, it's so confusing, Tom. I mean, you guys, I don't know if you hear this a lot, but there are a lot of CPAs who really themselves don't understand the guidelines that well. So yeah, which is why it's again highlighting the importance of working with someone who is, who that's their zone of genius, working with real estate investors, which is what Tom and Brandon do a lot. Okay. The next question we have is when we're closing our first short-term rental, could you give us a list of things to keep track of to ensure that we're maximizing our deductions? I believe that's the question.
Yeah. So I'll give you the quick checklist. So the first thing you do, you want to make sure you're meeting the short-term rental exception or the loophole. 7 days less or 30 days less if you're providing substantial services. That's the first thing. You're going to want to make sure you're materially participating. So you're going to want to make sure you're meeting one of those 3 tests: 500 hours or more, 100 hours or more, and no one else spends more time than you, or you're doing substantially everything yourself. You're also going to want to keep a time log to make sure that you can substantiate your position if you are ever audited. From there, you're going to want to make sure that you place the property into service by year end. You have as many stays within those limitations I mentioned before, 7 days or less, or 30 days or less if you're providing substantial services. You're going to have a cost segregation study performed on that property to break down the useful life of the components so that you can use the 100% bonus depreciation on that 5, 7, and 15-year property. And that's the big nuggets there. To a lesser extent, if you're going to want to take advantage of the de minimis safe harbor, you're going to want to try to do as many repairs or maintenance or place as many like furnishings into service after you purchase the properties, after you start renting out the property, basically, as possible. So that, long story short, that's probably the big nugget checklist that you probably want to keep in mind for short-term rentals.
Awesome. Love that, Tom. There's another question about, from a tax perspective, does it make a difference if you purchase the property in your name and transfer it to an LLC versus purchasing it in an LLC?
No. Long story short, no. If the LLC is taxed as a disregarded entity, it's going to be taxed as if the short-term rental was not in the LLC at all for tax purposes. If you do it through a partnership, it'll ultimately pass through to you. And regardless of whether or not you buy it and put it in there or you buy it within those LLCs to begin with, for the most part, it's not going to make a difference.
So the next question we have is from Abhijit, and his question is, if we're placing the short-term rental in service in December 2022, do you think I think logistically it's possible to hit the $100 material participation test, towards the end of the year, if we're at the end of the year?
Yeah, I mean, I think it's certainly possible. 100 hours. I mean, it all depends on the facts and circumstances of the situation. Possible, again, certainly. If you were to buy it in December, is going to be roughly 25 hours per week. So it's just, you're going to have to make sure that you're spending the right amount of time, legitimately spending that time on it, keeping your time logs for it so that you can substantiate it. And that's the best you can do. It's perfectly possible to do. It's just, you have to put in the work and make sure that you're doing the right things.
Tom, this question we get a lot. We have a lot of members in the community who are on an H-1B visa. Now, in terms of material participation and moving that short-term rental into the active bucket, do you know of any implications if they're on an H-1B visa as opposed to having a green card or citizenship?
Yeah, I'm gonna be upfront. I don't know the answer to that question. Would have to take a look into it. Haven't really seen it too much. I would, if you're generally speaking, if you're filing a U.S. tax return, you're going to be following the U.S. tax laws. So if you have to file a U.S. tax return, for the most part, you should be able to use these rules and everything I just mentioned. But I would double check that with a tax pro, because like I said, I'm just not 100% sure off the top of my head.
Yeah, and I agree with Tom. Sometimes it's a question for your immigration attorney, because your H-1B can be restrictive in terms of what is active. What you can do to produce active income. As long as it's in the passive bucket, I know if you're on an H-1B visa, you can acquire rentals, long-term rentals. Those are considered passive. You have the ability to do that. But when you're shifting it into the active bucket, it probably is a good idea to connect with your immigration attorney and make sure that that is okay with your visa status. Okay, so we have a question. So I think Samana has this question, and I have a related question. If we have a commercial property under a separate LLC, can we use? So I guess the situation is a lot of physicians, Tom, they have their practice, and then they buy a commercial property, and that's where they're going to move. They're going to move their practice into it, and it's and they're going to practice out of it, right? So they're using it for their business, but it's the properties under a separate LLC, their businesses, the practices run under a separate LLC. How do they make sure? Because I've heard you and Brandon talk about this on a recent podcast or a clip where how do they group and make sure they're maximizing bonus depreciation? Because I believe you don't automatically get to depreciate that property and use it against your clinical income, correct?
Yeah. So there's a few things that need to happen. So the biggest thing when this happens is the ownership interests in the building and the entity that owns the building, like let's say the LLC, needs to be have identical ownership interest as the owner of the business. Or basically whoever owns the business has to own the property. So for example, if me and you were to buy a medical practice or own a medical practice 50-50, we'd also have to own the building 50-50 in the entity. Once that happens, we can make a grouping election. This grouping election is found under section 1.469-4. And we can basically, what happens is for tax purposes, the building effectively become part of the same business activity as the business. So the losses from the building will become non-passive.
So that's like the self-rental rule, right? When you make that grouping election, so I guess it's not really, but it makes it non-passive. So you can use those losses against your active income, essentially.
Right. It's the thing about it, the best way to think about it is as if the business owns the building, right? It's as if.
As if. Now, does this have to be done in year one when the property is placed in service?
Yeah, so it typically has to be done. It has to be like once both activities are acquired, that election has to be done on the first tax return that happens.
Does have to be done before the end of 2022 if it was acquired in 2022, or can it wait till the tax return being filed?
Oh yeah, great question. So it has to be with the tax return.
With the tax return.
Wait till after the year, whenever the 2022 tax returns are filed.
And if one spouse is on the LLC and both the practice LLC and both of them are owners in the building, does that affect things?
So we've done some research on this. We dug into it. Long story short, because the taxpayer is ultimately the same, meaning if you're married jointly, it all funnels through the same tax return. You'll be fine in that instance.
Okay, perfect. Samana, if you have any other questions about this, feel free to unmute yourself. So I actually have this is one of my questions to ask you. Tom, meanwhile, along similar lines, if someone owns, say, a single family home and they consider that part of their, say, telemedicine practice and they start renting it for that purpose. And so it's considered an investment property, but their practice actually rents the space and it's a single family home. How does that work with the self-rental rule and with it being a single family residence?
Yeah, so the single family residence, is not going to be an issue from a tax perspective. There might be stuff with zoning in the town or county or whatever, but for a tax perspective, it's not going to matter that it's a single family residence. What you're going to run into, though, in that situation is the self-rental rule. You are going to run into that. What that basically means is that the rental income is going to be non-passive, meaning so it's not going to be passive, meaning you can't offset it with passive losses. And then also the losses are going to be considered passive. So you get the worst of both worlds.
Got it.
Which is why the self-rental rules are such a pain.
So your losses are going to be passive, but your income is considered active. So you're paying higher taxes because of their self-employment, because of it being subject to, so passive income and active income, you end up paying more in taxes essentially?
Well, the thing is just with the passive income, the non-passive income, you can't offset it with passive losses.
That's where you get tripped up.
Yeah. So basically you can't say, okay, I'm going to go rent this property out to myself, and then I'm going to buy another rental property, use the passive losses from that rental property against that rental income that you're receiving from the self-rental. That does not work, unfortunately. Makes sense.
But if the individual has real estate professional status, then it doesn't really matter because that's going to be active anyways. Okay, perfect. Makes a lot of sense. Perfect. Okay, so moving on to the next question. So Abhijit says, should we place a property in service first and then buy furniture to be able to use the de minimis safe harbor? How does that work practically, Tom?
Yeah, practically, I mean, that's a question that's a question that you're gonna have to like kind of figure out through your plan, where your market is and all that, because like, let me just play a scenario through my head. I'm gonna play this right now. So let's just say that, you bought the property, you place it on Airbnb, right? So you place it in the service and it's not furnished. Well, you might not be able to rent it out to anybody. It's gonna be sitting on Airbnb. So that means you have to go buy the furniture. You have to go furnish it in order to rent it out. So that's kind of what you're gonna be dealing with. You might place it in service, you might list it for rent, but you can't rent it out until it's furnished. So you have to make sure that you're ready to go get it furnished right away. Pretty much, like, that makes
Yeah,
sense.
right. So
Yeah.
Tom, what I mean is like you put it in the service on paper, and then quickly buy the furniture and place it, and then accept a rental. Until then, you have right to not accept a rental. Is that right understanding?
Right. Well, I mean, if you list it, part of making it available for rent, and technically placing the service, if someone did want to rent it out, you'd have to rent it to them, if that's what I'm hearing correctly. But yeah, so that's kind of how it
Yeah.
works.
I almost feel like, Tom, sometimes people get properties where they have old furniture in there and they want to go and refurnish it. So it may be better off placing it in service for a little bit and then refurnishing to be
Right.
able to,
Right.
yeah, to be able to maximize their tax benefits.
Right.
Does that help, Abhijit?
It does. It does. Thank you.
Awesome. So we have another question from one of our members who's also on an H-1B. We talked about the first part of the question. The second part is, can passive losses from rentals be used to write off stock capital gains and other type of passive income?
So as far as H-1B is concerned, that's I think irrelevant to this question. So passive losses cannot, from like rental real estate or a passive business interest, cannot offset capital gains or dividends from portfolio income, things like stocks, bonds, mutual funds, index funds, things of that nature. And that goes for anybody under the U.S. tax code, unless you're a real estate professional or you use like the short-term rental loophole.
Yeah, but then if a lot of physicians have passive income from ownership interest in surgical centers or endoscopy centers, which is technically considered passive, and that's how they're paid that income. So that's something that they would be able to offset with passive losses from rentals.
Right. It's a passive activity for them because they're not materially participating in it. Then they can get losses from rental properties and use those passive losses against that income, because it's also passive. So passive income is usually from rental properties by default, unless we use one of the reps or short-term rentals, but it can also be from business interests in which you do not materially participate. And usually those business interests are either in the form of a partnership, S corporation, or a sole proprietorship that you just don't materially participate in. C corporations usually do not fall into that bucket.
Oh, C corporations do not fall into, so passive income received from a C corporation does not qualify.
Well, C corporations pay tax at the end. Corporations, they pay tax at the C corporation level. So they'll pay tax first, and then when you get the income, it's dividend income. And dividend income, unfortunately, is not passive income for the purpose of the tax code. So that's kind of clarifying what I meant there.
Perfect. Thanks, Tom. How does oil and gas work over there? Because I've heard about that being, that's something that can sit in the passive bucket, correct?
So oil and gas. So if you have a working interest in oil and gas, working interest typically means that you're a general partner and you have unlimited liability for the in that interest, which could pose some risk to you, right? If you have that working interest, it's non-passive by default. It doesn't matter whether you materially participate. There's a specific carve out in the tax code for oil and gas working interests. That's the risk you carry, is that if someone falls and dies or something on the oil rig or something, you're exposed to liability.
So there's a liability part, but you don't need to hit material participation as long as you have a working interest. And so some people who have these syndications, I guess, where you buy into the syndication, but I assume it passes on that working interest to you.
Right. So you'd usually buy in. You're going to be a general partner. Now, some of these syndicates will go passive, will make you a limited partner and some subsequent year to reduce your risk.
Got it. That's cool.
So that's kind of how oil and gas works. I honestly don't see it too often, but it is a potential tax savings tool for people.
Got it. So we have another question. We hear this all the time. If there are three partners investing in a short-term rental, can all of them take advantage of the tax strategy?
Most likely not, practically speaking, and I'll break it down why. Because the three tests that matter: you spend 500 hours, which means that every partner would have to spend more than 500 hours. So that's $1,500 hours, which is unlikely to actually be legitimate for a short-term rental. And then you do substantially everything. So if you have three partners, not each partner cannot do substantially everything themselves. And then the third test, the 100 hours, and no one else spends more time than you, well, then only one partner would be able to meet that requirement, because one partner have to spend more than 100 hours and more than all the other partners. So long story short, usually in practice, what you see is only one partner is going to be able to get it if it's one short-term rental. Now, if you have a portfolio of short-term rentals and you have a thriving, business, and you're adding to it, and it's an enterprise more than it is just a smaller business, then maybe you could all get to the 500-hour test. But I've not seen it really happen.
Makes sense. And I've seen parents purchasing short-term rentals for their kids. And I always tell them this, that one of you can materially participate, most likely, just, logistically speaking, you're both not likely going to be able to get the tax savings on both of your tax returns. So something to always talk to your CPA about to make sure you're doing this right and you understand the implications. So we have another question. So if I'm not materially participating, what are the tax advantages that I get with my short-term and long-term rental properties? I feel like we covered a lot of this before, but you want to just wrap it up, Tom?
Yeah, I could break it down again. So, basically, when you have rental income, it's taxed at your ordinary income tax rates, meaning that if you had positive rental income and you're at the 37% tax bracket, you're paying 37 cents on every dollar in taxes. However, thanks to the non-cash expense called depreciation, which we've mentioned here, that allows you to shelter that rental income from tax. So basically, you can have positive cash flow. You'll be putting money into your pocket and not paying tax on it. So that is that is one of the major benefits of investing in real estate that anybody could tap into, even if you're just on the passive side. Additionally, those losses can also help offset gains on the sale of rental properties. So, especially with bonus depreciation being as powerful as it was over the last few years, we've seen clients not pay taxes on the capital gains, which is where you usually make a lot of your money, especially in the environment we've been in, because you're able to use those passive losses against that income. So that's kind of the benefits. And also, as a passive investor, you could also use 1031 exchanges, if you own the property directly. So basically, as a passive investor, you're looking at tax-free income. That is the biggest benefit to people who are in the passive bucket. I'm in the passive bucket. I don't use reps, and I don't have a short-term rental at the moment, so I can't use the loophole.
Yeah. And then like another big benefit is when you start building up enough equity in the property, you can do a cash out refinance. And that's a tax-free event. You can pull out hundreds of thousands of dollars and just not pay any taxes on it. So there's so many ways, like Tom said, of producing tax-free income, which especially for those of us living in California, we're really taxed on our income. So just having tax-free income automatically, like Tom was saying, puts you in a very different effective tax bracket.
Absolutely.
Okay. So this question, I wanted to save this for the end, but I'm going to ask you now anyways, Tom. How can people who need help with real estate tax planning work with you on an individual level? So do you want to talk about this, Tom? I know you guys have, the tax planning services, the tax courses.
Yeah, absolutely. So I'll kind of break that down. So the way it works is we offer one-on-one comprehensive tax planning to clients. So basically, if you wanted to work with an advisor one-on-one, we're going to take a look at what your situation looks like today. So what your properties are, what your income is, and as well as what your goals are over the next handful of years. And we're going to put together a tax plan for you that basically outlines a number of strategies that you can use to reduce taxes. We're going to walk you through what the tax, what each strategy we're recommending is, how it applies to your situation, what benefits you get by using it, and then ultimately what action steps you need to take. So that is one way to work with us, that individual tax plan. That usually starts at around $4,500. So that's kind of one way. Then we have courses courses that basically allow you to educate yourself on this. And you could even, we've had people go and use this course with their CPAs and their tax professionals to actually implement it into their tax returns. So, for example, we have the short-term rental tax course that literally breaks down everything you need to know about short-term rentals to use the short-term rental loophole from A to Z, breaks everything down. Then we have a course called Tax Strategy Foundation, which I believe Param actually went through a version of this. And there we go through the real estate professional status from A to Z. We go through short-term rentals from A to Z. We go through optimizing your tax position through safe harbors, like the de minimis safe harbor and planning for repairs and maintenance. We go through exit strategies like using cost segregations as an exit strategy, 1031 exchanges, paying your children, entity structuring. We literally go through. It's called Tax Strategy Foundation because we literally go through everything from A to Z you need to know as a real estate investor to reduce taxes. So that's kind of the two ways we help people on tax planning. We have the comprehensive one-on-one, then we have the courses, and then finally, and this is more along with the courses, we have a community Tax Smart Insiders where we host 4 live Q&As per month, kind of like this, where it's answering a lot of questions, and then also a forum where you can ask questions, and we have a backlog. We have like an archive of videos, an archive of articles of tax planning. So that's kind of in a nutshell how it all works.
So on so many levels, right? Whatever works for you guys, you have an option that you can pick from. Like Tom said, and I've said before, I took the course and I use it all the time throughout the year to help me plan. And then I use it when I, go and file taxes also. I have put a link on Facebook, and I'm going to send a link out along with the replay to this to all of you. You can use that to get, access Tom and Brandon, the real estate CPAs website, and you can pick what makes the most sense for you. And they actually gave the Generational Wealth MD community a discount code where it's actually over 50%. Tom, I put it in there, and it's like yeah. So you get like a significant discount on any of the tax courses. So so you guys just make sure you use that. Figure out what makes the most sense for you. But it seems like for any level, at any point where you are, if you're just getting started and you may just have questions periodically, you have the Tax Smart Insider, you have the tax courses if you really want to just get hardcore and learn all of the stuff, which I think is super helpful, because you don't know what you don't know, and sometimes even to present it to your CPA, you really need to know what you could be taking advantage of. So that's there. And then you have the tax planning, and tax planning and tax filing are 2 different things, and planning is really, really important. So yeah, I love what you guys are doing, Tom.
Okay, no.
Do we have time for a few more questions? Because I know we're like really late. Maybe we'll take one more.
Yeah, I could take it. Yeah, 1 or 2 more for sure.
Yeah, so let's just do one more. Tom, this is a question I get a lot. People trying to invest in real estate through their self-directed IRAs or their 401s. And I just wanted to touch upon that a little bit. So how does it work when you're buying an individual property through your self-directed IRA in terms of taxes, tax implications versus a 401? And how does it work with the syndication?
All right. So kind of works very similar in both scenarios with the syndication or the direct property yourself. So through an IRA, there's something called UDFI, unrelated debt financed income. And that's going to be the income that's attributable to the debt financing. And the simplest way I could illustrate this is, let's just say you had $10,000 in rental income, like that number, nice and round. And let's just say you had 75% LTV. So you got, you put 25 down and you took 75 on debt. Well, basically 75% of that, or 7,500, would be considered unrelated debt finance income, or UDFI. Now, UDFI is subject to UBIT, the unrelated business income tax. This is a mouthful of terminology here. For income above 1,000. So if you have, in that example, $6,500 of taxable rental income, you're going to pay the trust tax rates through your IRA, and your IRA pays that taxes. Now, what I will say is that we usually don't see many taxpayers paying UDFI throughout the life of the property. Usually you see UDFI come in during the sale. And in my experience, it's really only knocked down the gain, the ROI maybe by 1 to 3%. It's not usually substantial through the IRA. But it is something to be aware of. It's not completely tax-free thanks to that UDFI. And you do have to file Form 990T with that. So you have to make sure your accountant files that form or is aware of the rules around filing that form, because you don't always have to file it. But long story short, you want to make sure that you're crossing that off your checklist. When it comes to 401ks, whether it be a self-directed 401k or a solo 401k, solo 401ks are not subject to UDFI on rental properties. So you don't have to pay that tax. So in other words, you invest in the rental property directly or through the syndicate in your 401k, you're generally not going to have to pay that UDFI tax. It's the preferred retirement vehicle for investing in real estate if you can have access to one.
Now the tax, is that only on cash flow, or is it on the entire income that's produced by the property?
So it's on the net rental income. So usually you're gonna have your rental income, then you're gonna have your expenses and depreciations usually in there, and that's the net amounts what you're gonna have to pay taxes on.
And if you do end up having gains at the if you sell the property towards the end, so 75% of the gains are not subject to additional taxes?
Well, so the way it works is over the course of your loan, over the course of the property, the loan is gonna be what is the principal pay down, right? You're gonna start paying down some of the principal, and that there's an equation complicated. It's gonna not be exactly 75%, give or take, is what's going to be subject to tax. And usually it's I'm trying to find it's really hard to explain it because the calculations is really
okay, because when I looked at it and it said UBIT taxes are around 37% after a certain number, it seems like a large amount considering that at sale the gain 75% of the gains may be subject to that 37% tax. But what I'm realizing is that that's not necessarily how it plays out.
Yeah, it doesn't really play out like that. It's usually not that bad, and it's taxed the trust tax rates, and the trust tax rates they go up to 37% really quick. I think it's around 13,000.
Yeah, something like that.
So that's just something you have to keep in mind. But also the UDFI, the acquisition indebtedness is usually not going to be at 75% when you're selling the property. So it's usually not going to be that high.
Makes sense. Awesome. Thank you so much, Tom. This was so useful, and you've been so patient with us. I'm sure everybody got a ton of value from this, and I'm glad we talked about all the different ways that you can help our community of real estate investors. And you work with a lot of physicians. I know that a lot of people who are LPs and syndications, people who are starting short-term rentals, long-term rentals, or have really large portfolios. So whatever stage you're at, I'm sure you can really benefit from their assistance and their expertise.
Thank you for having me. It was an honor to be here. Happy to be of help.
Yeah. Thank you so much, Tom. Thank you guys for sticking around. And we will wrap this up. And those of you who are going to celebrate Diwali, happy Diwali again. Thanks for making the time today. If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.